Good afternoon, everyone. Rich Swerbinsky with the Mortgage Collaborative here once again with the last week in Mortgage Today, our weekly look at all the latest and greatest happenings in the mortgage industry. Each week, I am pleased to be joined by one of our lender members as my co-host, and this week, longtime TMC member, President and CEO, American Mortgage Service Co., Bill Case. Bill, thanks for joining me.
Oh, Rich, thanks for having me. Appreciate it. And I noticed you had the emphasis on long. I appreciate that.
You were one of the guys, I remember when we got TMC going, and it was really at that point just hopes and dreams. I reached out to you basically pleading that I thought we had something cool potentially going on. And you were one of the people early on that really bought into what we were thinking with TMC, and I really appreciate it.
Well, guys, you put it together the right way and continue to look for ways to innovate and be valuable. And you've done a great job on that, you and the whole team.
Thank you, Bill. And just to level set with the audience, I always like to let the audience have a sense of our co-host, the type of shop that they run. American Mortgage Service Co., based out of Cincinnati, IMB. Just if you could level set with the audience, volume from last year, any unique initiatives you guys have in the hopper as we get into 2021 here.
I would say, well, last year we did somewhere between 1.3 and 1.4 billion. I didn't have that right in front of me. It's somewhere there. Respecting numbers somewhat close to that, which is surprising because I thought it would go down some. Purchases have gone up significantly. I would say that the initiatives aren't so much what are we doing this year. It's all the things we were not able to do last year that we were planning on doing. Getting waylaid. Obviously, we in the industry were just incredibly busy. So, refocusing. Really, a lot of what we're doing is technology and tools for our LOs to really allow them to be as efficient as possible, whether that's a lot of volume, a little volume, or whatever in between. That's really been our focus for the last few months.
Excellent. All right, so let's get into it. As always, no shortage of headlines in the news with regards to our industry. Of note, last week, both Fannie and Freddie made fairly major appointments. Freddie Mac hired a new CEO, Michael DeVito, who ran single-family lending for Wells Fargo for some years. Fannie Mae appointed internally a new head of single-family lending, Malloy Evans, their current chief credit officer. But more broadly, Bill, just would love to get your perspective on your just experience in dealing with Fannie and Freddie, throughout the pandemic and the time leading into it. And just your thoughts on the GSEs, as obviously could be moving into a period of uncertainty with Fannie and Freddie, and kind of Mark Calabria, his role as FHFA director, could be hanging in the balance here. A lot of changes recently that we've been talking about on this program, and others. Would just welcome your perspective on the GSEs as we get into the spring here.
I would say overall, you're just looking for stability. And I would say that's probably been, I'm 36 or 7 years in the business, and that's always what you're looking for partners in a regulatory environment of stability. And stability doesn't have to be that there cannot be changes. It's just when the changes come, you'd like to, are you able to react? Except for catastrophic events that something has to change immediately. I think last year was an example of that where, everyone was caught off guard, and some of the things that went on at the GSEs last year, you could excuse some and say, okay, well, they were trying to do things on the fly, just like we were dealing with. All right, how are we dealing with forbearance? What are we doing with any delinquencies when we buy these loans? I think everybody was feeling along there. But when changes that create more instability that probably could be phased in over time, I think those are the things you look for. The gentleman you mentioned from Wells Fargo, you hope there that somebody coming in from the lending side and understanding that, okay, here's the challenges we meet or we have to deal with every day, that there's an appreciation for that. I think overall, it's been said so many times. I know Rob Chrisman many times in his column, we have an industry, not like similar to others, but we're so good at adapting, but we just need some time to adapt. Having changes thrown out midstream or putting some dates on that make it really difficult, if not impossible, to predict how you can handle things, that makes it difficult. I'm hoping, I mean, even Freddie, I think, backed off a little bit. Fannie Freddie backed off a little bit with some of the changes allowing new construction loans. You hope that there's some common sense and that there's people listening. And I think that since housing is kind of ground zero for a lot of the economy, I do believe that my opinion is only that nothing incredibly drastic probably happens, because I think there's enough people that are listening who can have input, and it's not really just a few people making that decision. So hopeful that changes are okay to come, but just give the industry time to be able to adapt and do what they need to.
Could be a really interesting period of time coming up this next month or two with Fannie and Freddie. You mentioned Rob Chrisman. He, in his column this morning, the room mill, which he'll often do to kind of get a week started, was also some things we've heard from some members, just that they've maybe heard from a little birdie or were speculating that could be coming down the pike, an increase to G fees, which, mortgage lenders will kind of not really see. They'll see it embedded into their cash pricing, not overtly. Potential reduction from the 7% of the non-owner to 6 or 6.5%. These certainly would not be surprising moves as long as Calabria is still head of the FHFA. He's every time had a chance to speak on record, done nothing to walk back any of the decisions or opinions he's put out there, and always kind of talked about wanting and needing in his mind to do more. So, but to your point, just telegraph it a little bit. The 7% thing was kind of thrust onto the industry. I still don't know if there's full answers on the rolling 12 months and some of the mechanics around how that works exactly. Has your account reps with the GSEs provided any?
No, because I'm not even sure they know, to be quite honest. I mean, they're not necessarily getting any better information than a lot of us are getting. So, it's bits and pieces. And I think that in my own mind, I think those are two separate things. I mean, non-owner occupied and the second home issue, the second home, that one to me is a little more, maybe that should be in their charter. The non-owner occupieds, I again, give the lead time and make sure that people have the ability to adapt, and there's another way to go. But I'm not sure how much business Fannie and Freddie should be buying, not straight non-owner occupied, because especially in the markets like this, probably not helping single family sales because you have investors that are buying and it's a pretty good price. So the pure investor, not the owner occupied that has multi-units, but the pure investor, I don't disagree completely with looking to cut that down a little bit. Second homes, I feel those are consumers buying and typically not renting for the most part. But we'll see. But like anything else, it's just you got to give us time. You got to just say you can't just say, well, here's something effective, then it's effective 2 weeks from now. FHA used to be notorious at that, and they've gotten better the last number of years. And I don't know, maybe some of the people that were there went over to the GSEs. So we'll see.
Yeah, no, great point. Not really part investment property. It's not really part truly of the Fannie and Freddie charter, but second homes. I mean, second homes right now, for a lot of different reasons, sales of second homes are very high, and that's why I caught a lot of mortgage lenders off guard. But yeah, I would agree, kind of separate issues. So this is the last week in mortgage today. I'm Rich Swerbinsky with the Mortgage Collaborative, joined this week by American Mortgage Service Co. President and CEO Bill Case. Bill, M&A, still pretty expected to be rampant, maybe on the lender side as we move forward. On the vendor side, it really has been throughout the course of the last few years. Black Knight is on an acquisition spending spree. I think this was their 9th acquisition in the last 2 or 3 years. Acquire Top of Mind, CRM that I think it's probably 2 or 3 overall market share CRM in our industry. Any thoughts on that acquisition or the M&A climate in general in our industry?
Well, from the vendor side, I guess, since you mentioned that one, I've had people in our company ask outside the company, and, what do you think of this one? I think of that. It's the first thing I always tell them is, okay, this will go on. It will always continue to go on. That's just the nature. And most industries, there's mergers, people looking to buy up to. I said, one of the things that I think for me has changed the last, maybe it's, I gotta say a few years, but it could be 8 to 10, 12 years or more. Um, Sometimes there was a fear of, okay, the bigger entities buying up small entities, and then do they corner a market, or do they make it difficult for others to enter? It's interesting how technology has clearly upended that, where a few people can get together and have an idea that they can put into action, go out and find their own private capital. I mean, in most cases, that really is the end goal anyway. Most vendors, if they're in an honest moment, we would tell you that, they're not looking to provide documents forever in the mortgage industry. They're build something that somebody purchases, and then maybe they go on to their next idea. But technology now, like I would say now, I have no fear of like, oh, that place is going to dominate the market, because it's almost as easy now for a small player to come in and provide pieces of the technology that a larger player can have. And sometimes the nimbleness of the small player is still there. I think as long as, the thing you're always concerned about is if you are working with one of the larger players, that they're not allowing you to use other vendors. I mean, that's always the concern if you're a company that, well, I'm tied up with somebody now and I can't, they don't have to use the vernacular, the open APIs, I can't do that. I think that presents the problem. I think you want to be where you're not necessarily going to be tied in, because in the end, it's difficult to be good at everything. If you retain the same talent, but a lot of times what got that player to a certain point to be attractive to be purchased, sometimes those people leave. So I see generally it goes two ways in that type of space with vendor purchases. They're either bringing capital, and then they can bring significant improvements to things that the company wanted to do, but that was not in the position, or they just bring in their bureaucracy and choke off the innovation. So probably more often than not, it's an improvement, because they do see it, otherwise they're going to lose the customers, but usually goes one of those two ways. On the lending side, I think, we'll see. There's always going to be people looking. I think it was interesting though to see all the comings and goings last year, when I just hope investors are realizing that that may be the single best year in the industry ever. So you're unlikely to see returns like that again, but you'll always have that, because people are going to be looking to grow, looking to exit the business, whatever their motivations are. But there's always players that will be there, large players, mid-sized players, small players, which is great for everybody.
Absolutely. Redfin came out with a report, I think it was late last week. I think it was April home sales, over 50% went for over asking price. I've never seen that percentage anywhere close to that. Obviously a pretty batty market right now, housing market, the obvious supply demand issue that we have going on right now. But your general thoughts on inventory right now, values. It appears like there's no quick fix, or maybe even medium-term fix to the inventory issue in the housing market right now.
You're absolutely right. I think, everybody's seeing the same things. We're at 40-year lows for inventory. And by the way, when I saw that same thing you're referencing, 17 days, my first thought was, really that long? Because I don't know how many people I've talked to that their houses are barely listed and they're sold, and multiple bids on them. I think that there is no easy solution, and you're right. I don't know that there is a midterm solution. I think the only throwing your hands up and walking away is going to be one of the solutions for a lot of buyers. And you're reading about some of that now. And I've got people that I know, even in family, that I've kind of said, unless you're finding something right now, you are better off just waiting, because this could be something that is going to take 2 to 4 years to maybe really come in line a little bit, supply and demand. So in the meantime, I think people are just going to walk away. I think you're going to see rates obviously trickle up a little bit, and supply, there'll still be lots of transactions, but obviously we could have more. On the value side, the concern I have there is not like the last time, 12, 13 years ago, where, what happens if, it's funny to read things about, the CARES Act and holding back foreclosures, like, and then you'll read, well, foreclosures might kick up. There's probably a lot of people saying, good, can we have some more foreclosures, to have some more? And obviously,
Close some
not
homes,
the
right?
people in those circumstances, you don't want to wish ill upon them, but we'd like a little more inventory, but I don't think that's going to happen a lot, because I think most people could sell their houses if they really want to. So I don't think we're going to get bombarded. But I think instead of the bubble, I tend to think it's going to be a balloon that you're letting some air out the end, and then it's going to fix itself. I don't think it's going to explode. What I've told some people is, I would be leery if you're buying a house now that your intent is to move within a few years. I would think long and hard about that and how much you're paying, because while I don't think we'll see values drop across most markets, I'm not saying you could see that pockets like you always do, but I don't think you'll see mass drops in prices. But you could see that, okay, I paid $600,000 for a house today. In 3 or 4 years, maybe it's still worth $600,000, or whether it's only 570 or 580, because now things are in line a little more and there's some competing homes. So you got to be careful that while it's going to continue to appreciate, that probably is not going to happen most likely. And it is not a good thing to continue to happen anyway. We need stable markets for all of us, buyers, sellers, lenders, governments, everybody. We need a stable market.
As I sit in the kitchen of a house I just bought, yeah, I hope that we don't see a major correction. My last house I bought in 06, I picked the wrong times evidently to buy homes. You think being in the industry, maybe I'd have it figured out a little bit better, but
You'll be fine.
will be interesting to see what happens. So as a result of a lot of the things we were just talking about here, we've seen some of the major economists in our industry come out and revise their projections for 2021, not materially different from a total volume standpoint. Right now, most economists are projecting a year somewhere between like 3.1 and 3.4 trillion. Last year came in at a little over 3.8, a record year. So by everyone's estimations that's in the business of making predictions, going to be another really good year for the industry. What we're seeing on the revisions, though, is a revision down on purchase, the mix of purchase, and revisions up on the mix of refi. For, again, all the reasons you just mentioned. Purchases are very much restricted and hamstrung by the supply issue. The Fed, even in the wake of some, concerning to alarming inflation data, has remained, very dovish on their long-term outlook and their commitment to keep buying the long end of the curve. Rates have stayed very low. They've dipped down now back into the high twos for the best rate on a 30-year fixed rate. People are amassing value, making cash out refis more attractive. Your opinion as you look at the last 7 months of this year, you think we'll end up with more refi and less purchase than you would have projected coming into this year?
Well, yes, because we probably were expecting less refinance already to this day. I mean, we're seeing now, we're probably running 80% purchase the last month and a half, 2 months. Last year, and again, for us, that's even a higher number. Last year, we ended up about 31 or 32% refinance. Again, traditionally, we're running about 10% refinance, 11% refinance. So those are extraordinary numbers for us. I think refinances, they have performed better, and some of that is because of rates. Rates are probably too low. And I know there would be people that argue with that, but again, I'm going to go back to my old economics background, but they're too low. I think they don't need to be this low. Clearly in our space, I'm not going to speak to other areas of borrowing costs or businesses or anything else, but home interest rates don't need to be this low. I think the Fed could back off a little bit with some purchases, because, if we're in the mid threes, that's not going to hold up purchases. It's all about inventory. People are going to buy. It's not going to stop them. And yet, if for those that refinance for, I'm getting cash out, or I'm just lowering my rate, but if it's the over and over and over again, I don't know how much that helps, because I'm not sure that helps the purchase market either. Then there's maybe less of an incentive to move because, well, now we just refinance, we have a lower rate. But I expect purchases will probably, or refis will still be higher for the year than anticipated, but I don't know. It won't, it can turn on a dime, because all it will take is one Fed policy meeting minutes to come out to say they're going to slow purchases. And if you see rates go up 3/8 to 0.5%, which would be extreme. Is that enough to cut significant amounts of refinance? Absolutely. So I would be very reticent about making any predictions. Never been good at that business anyway. And I ask all the people, how did last year's predictions come out when you were in January last year? What'd you think? So we'll see. I mean, it's going to be a strong year. I still think purchases will be very strong, more refis than we anticipate. So a good, strong year for the industry.
Very rarely does any year in the mortgage industry play out how
No.
there's almost always consensus as you get into the start of a new year. Oh yeah, and then for whatever reason, last year wasn't a dramatic example, but yeah, to your point, always seems to play out a little bit different. So this is the last week in Mortgage Today. My name is Rich Swerbinsky with the Mortgage Collaborative. This week, joined by American Mortgage Service Co. President and CEO Bill Case. Got about 7-8 minutes left with Bill. If anybody has any comments, questions, please feel free to drop it in the chat or the Q&A, and we will voice it aloud. And Bill, I always like to get a sense of just the current business climate with our co-hosts each week on this show. Margin compression is a term that I think we in the winter of 2019, we all got sick of hearing. And last year, we obviously great volume, great margins, obviously compression of those margins, inevitable. We're already starting to see to what degree have margins compressed, and how do you think that'll play out throughout the course of the rest of the year?
I don't think it will continue, but I also think we're getting back to normalcy there. I mean, just last year were margins that I have never seen in 30 some years. I mean, but also because it goes with the fact that you had a purchase market that was strong and a refinance market that was incredibly strong. And typically those two have never been together. Usually it's one or the other. So the fact you have both at the same time, competition, borrowers trying to find somebody that could even take their loan, let alone, take an application, get to closing, or answer questions or whatever. So you were not really shopping much. But I think we've already seen. I mean, we so far this year we're seeing margins typically still above our norms, but nowhere near where they were a year ago, and that's okay. I mean, it's great if the extra income. I mean, that's wonderful. But you look at the causes of it as it's great, get it while it lasts, but it's not sustainable because you're just not going to be able to there's not an endless refinance market. So we'll come back down to where it is now, and I would suspect you'll see a little more compression because it will get at some point, and maybe later this year, early into next year, will it be a little more competitive and people start looking harder and pen to paper, which I mean, of our group, I've said this year, this is the year to make sure you're making the changes and preparing for late this year and next year, because that's when I think we'll all be tested a little more than we are today.
Work from home, where are you at with it? Is everybody back in the office? Where were you pre-pandemic? Were you one of those companies where just underwriters worked from home? And where's your mindset at now with the company as we get into the summer here?
We were, our IT director had told me once prior, right at the pandemic, whatever, we were moving people. He said we probably had about 40% that were working mostly or all at home anyway. So ramping up, thankfully, wasn't as big a deal. We met a couple months ago, senior managers. I asked them, but they said what I kind of thought hearing from people. People have been coming, those that want to are coming back to the office. We've not mandated anything. We're going to just kind of go see how it is. I mean, we saw productivity. Obviously, our productivity was pretty good anyway with people at home. It went up some last year. And clearly, as I reminded a lot of people, let's not kid ourselves. People didn't have any distractions last year. They couldn't do anything. So work became okay, that was a distraction. But now that they can resume a little bit of a normal life again, maybe the productivity is down a little bit, but we're good. We're probably going to leave it pretty open. What I suspect will happen, and I think across a lot of industries, I think hybrids are going to dominate. I think maybe you're going to have 10% of the companies that are never going to go back, 10% that maybe are forcing you got to be back all the time. And I think all the rest of us are going to be some semblance of maybe people are in, maybe it's a day or two a week, maybe it's a day or two every other week. Maybe that we schedule some things. We're thinking about doing that to get groups together, but we're spread out. We were spread out prior to COVID. So getting people of a group together didn't happen much anyway. And we always felt pretty good with the culture. I mean, people stay in touch. That's where social media has changed things so much from so many years back, where you really felt you're out of touch. Now, uh, people tell me things about me that I didn't even know because they read my wife's Facebook page. So, I feel like there isn't much we don't know about each other, and it will take a little more effort. You want to make sure you're staying in touch with people, but I think we'll be a hybrid like a lot of places.
You made a comment at the beginning of the episode that I thought was pretty telling, and just was asking what initiatives you had in the hopper for 2021, and you said they're old initiatives that we couldn't get to last year, and that currently, clearly the theme with our members. It forced to first panic and then just do nothing but react to mass inflow of applications throughout the course of 2020 and even into the beginning part of this year. Um, Emerging technology in the mortgage industry. I think most of our members would kind of classify it as, man, it's come a long way. We've got some great tools and borrower facing and LO specific resources that are pretty incredible, but that there's this next wave. There's this wave of kind of automated intelligence and better document recognition things that really stand to change the mortgage manufacturing process going forward. How would you assess the current state of that and how you look at it from like a here forward standpoint as a business owner and leader?
I think first, the um, technology coming to help for the back office for ops uh, was probably later than, in my opinion, should have been. I think we, as an industry or technology, we focused so much on the consumer facing, and obviously it rightfully has its place, but I felt like we're not a typical business that you just say, okay, I'm going to go online and order something. I mean, just it's not that. It's still too many nuances and complexities where you need to talk to some people. I don't know the differences in programs. And refinances aside, because obviously that's a little different. Purchases, we're not even the thing that they're really interested in. They're interested in buying a house, and they got to do, okay, moving and furniture. And I'm preaching to the choir right now, obviously, but you've got to deal with all those decisions, and you may have kids that have to go in school, and how we're doing this, and what's my commute, and that's, oh, and by the way, I got to get a mortgage. It's not the focal point of the transaction anyway. Really, the buyer getting the house is. So consumers, I've always felt they're pretty compliant with, here's what we need. I mean, I still know places that take handwritten applications and they get a ton of business, and because there's not a lot of frame of reference. Some consumers may say, well, do you have this? No, this is the way we do it. And it's like, oh, okay. Well, because I'm only doing it once every few years. It's not like a grocery store where, okay, well, if it's not convenient, it's not worth it to go there on my way home every day. So I felt like we did a lot of that, which was great, but I thought the back offices were neglected. I feel now it is great. There are more resources going in to help in that area, because so many repetitive tasks that that you have somebody just staring at or clicking buttons that we can move beyond. And I think we all look at our choke points and what takes time, and how can we be better at it. But I'm encouraged now, and things that I've heard and read over the last number of months, I'm more encouraged now about strides that we'll probably see over the next year, 2 or 3. And there's huge hurdles with some areas, but even if you can, if you can eliminate an hour here, a half hour there, it just makes an enormous difference. Because somebody can handle more files, and you have people doing a better job of quality review of files, rather than, well, I just have to get this done because it's part of the file. I got to click these buttons. So I'm encouraged now. I feel pretty good about things going forward.
Great stuff, Bill. Always enjoy talking about the industry with you, and appreciate you sharing your insight with our audience today. Thank you for joining me.
Sure. Appreciate it. Thanks so much for having me. Have a great day, and good luck with the house.
Thank you. I'll need it. Yeah, I'm surrounded by boxes. As I told you, like, it looks very serene behind me. To the left and right is just mass chaos. So
That's right. The sun is shining.
exactly, the sun is shining. And to our audience, thank you as always for joining us. We're here every Tuesday at 2 p.m. Eastern. This is the last week in Mortgage Today. Until next week, we'll see you then. Have a great rest of the week, everyone. Take care.